Good morning, welcome to IG's Early Morning Call. It's Friday, 3rd of January. I beg your pardon. Good morning and welcome to IG's Early Morning Call. It's the 3rd of February, 2023. Let's take a look at the headlines as we await today's start of the European markets as we look to continue to what's going on with the US dollar recouping yesterday's losses. Markets now waiting at NFP data. It's interesting to watch the context of this with 10-year yields now pretty much the lowest that we've seen in 2023. All this comes as we saw both the Nasdaq and the S&P 500 late last night move into bull market, but then Apple, Amazon, Alphabet all hitting the markets and pulling them back, not into any other direction other than bull, but nonetheless well off the highs. And we found a new liquid gold. Orange juice climbs to new record highs. Lots going on the story for these citrus fruits. Let's take a look at volatility as we look out on this, say, third day in February, as we've got the markets yesterday having hit 15-year lows for volatility. This indicates that there is this drive into risk assets that continues. And this is demonstrated by these bull markets that we've seen in many of the markets. FTSE 100, not so. But nonetheless, it's a really nice little trend that we've got going on here today. And we're looking for a new higher high in today's session from the recent price action that we've seen. We're highest we've seen since the 18th of January on the London FTSE. These aren't big candles. As you can see, they're quite shallow. And it's quite a shallow trajectory. The candle bodies are all relatively small, 78.16. But nonetheless, it is a move up in what is otherwise a market where there's a lot of tentative sort of hesitancy, I think, for some people. Not really liking the way in which some of these markets are being pushed up. Look at this now. We've got 31.7% up for the for the DAX since the lows we saw back on the 30th of September. Since that market has really moved up. And we're currently trading at 15,445. And you can see we are pretty much the top of the candle, or the top of the body of the candle yesterday seen on the DAX. So we're looking for gains across the European continental markets as well as here in London. Yesterday, the French CAC 40 saw new 9-month highs. And in fact, we escaped this right-hand shoulder of this head and shoulders pattern we had here yesterday, taking us to levels not seen since the 20th of January, 2022. So we're now more than 1-year highs for the French CAC 40, up 27.68% from the lows that we had back on the 3rd of October. So you get the picture that we've got money going into equity markets. These are risk assets. These are people prepared to take on risk. And we're looking for other areas of the market where we've got risk really very much front and center. Let's take a look at what's been happening overnight in the Asia Pacific markets. The Nikkei up almost 0.4%. The ASX 200 also having closed with gains. You can see there across the board. The weakness in the market is coming through in what's been happening in China. And this is represented here. You can see in the Hang Seng stock index down 1.3%. Part of this is what's been going on in China. The recovery is not coming through as fast as many had been hoping. In China, the Caixin Services PMI data out overnight climbing back up into expansion after 4 months below the 50 mark. The index rising to 52.9 in January from 48 in December. But this is as it wasn't really enough to help those that were expecting a far bigger move up, I think, in some of the economic data that we've seen from China. Nonetheless, small steps, and it is illustrating the way in which China is coming back into the market after the recent relaxation of the zero COVID rules, which I think is going to see a lot more demand coming through for a lot of the base metals, for a lot of the infrastructure type spending, which China is expected to expand on this year. There are still some concerns about the numbers of people with COVID. I think it's beginning to soften a little bit if you look at some of the anecdotal evidence. But nonetheless, you can see their Caixin Services doing well, relatively speaking, on from recent data. Now, let's take a look at Wall Street, because Wall Street are really, really interesting. We saw the S&P 500 and the Nasdaq yesterday climb up into bull market. And this, for those that follow Dow theory, is exciting, because Dow theory states that when you get one of the indices, in fact, they're talking about the Dow Industrials, Dow Transportation, Dow Utilities, all the individual Dow indices that are within Wall Street's performance. Dow theory goes back over 100 years. Charles Dow had this idea that when you get the majority of those indices moving up, you've got a trend in place, and that is marking the beginning of a new, really strong trend in that direction in the market. Yesterday, you can see the Dow, in fact, itself was down 0.1%. But when you get these markets moving like they have been and moving up, you've got to respect the trend. And you can see what's been happening. Let's take a look at the chart, because yesterday was really interesting. We saw this push higher. You can see the shape of the candle here with that wick, that really big wick on the upside. Now that's taken us up 23.61% from the lows that we had back on the 13th of October. So this is now taking us into bull. You can see the previous day, if I pull that back, we were just at 19.9% up. So this has taken it up into a new bull market. But I'll just leave that there for the minute, because you can see the shape of the candle with that long upper wick. What happened is that analysts were suggesting that what was going on Wall Street yesterday was that people were beginning to believe that the Fed is peaking on interest rates. Now, that may or may not be the case. Certainly, we had intimation from Jay Powell just the previous day that interest rates are unlikely to come down in 2023, but the market's nonetheless believing we are close to possibly the peak in the US interest rate rising cycle. And that's what pushed that market up. And that's why we then went into that bull market at 23.61%. Then came this move down back to reality on the 24-hour markets last night because of the earnings that we saw out last night from Amazon, Apple, and Alphabet, which disappointed, it has to be said. We'll go into some detail on that and how to trade those in just a few moments' time. So what do you do with this? Well, that's sort of a shooting star candle. When you get a shooting star candle or an inverted hammer, it normally indicates to you that there is possibly a peak in the market having been established. Now, you look at the 24-hour markets, and you can see now here we've pulled back on the NASDAQ. This is just a bit more air taken out of the tires. I'd want to see how today's market fares. We've got non-farm payrolls later on, which could help give us a little bit more of a steer. S&P 500, which is packed now with an awful lot more tech stocks than we have had over the last 20 odd years or so, more and more tech stocks entering the S&P 500. So same sort of price action we got there, off the highs at the close last night in respect of that late delivery of those earnings out last night. This is the Dow, just for the record. The upper part of the candle yesterday wasn't as big. The Dow is not known for its tech stocks, as we know. The 30 stocks on the Dow tend to towards the sort of the old type manufacturing type stocks more so. Which is why a little bit sort of less in terms of its overall price action. So that's where things stand at the moment, looking as though we've got a little bit of air, as I say, taken out of the tires on those equity markets. It wasn't just about US interest rates, it was also about what's happening here in the UK and the European Central Bank as well. As expected, both the Bank of England and the ECB raised interest rates by a margin of 50 basis points yesterday. The BOE main base lending has now gone up from 3.5% to 4%. 10th consecutive rise in interest rates. The European Central Bank main refi rate now stands at 3%, again up 50 basis points yesterday. And as expected, messages from the respective governors were very different. There was a divergence. The Bank of England Governor Andrew Bailey, the tightening in place since the end of 2021 is likely to have an increasing impact on the economy. Yes, looking as though we could well go into recession, but the news there yesterday was that recession is going to be shallower than had previously been expected. Remember the IMF recently saying that the UK economy was going to be one of the underperformers in terms of the growth in the economy, suggesting that there is going to be a worse recession here in the UK than other parts of Western economies, certainly compared to what's happening in Europe. Since November, Andrew Bailey said, the monetary policy report, we've seen the first signs that inflation has turned the corner. This was the other aspect of what we saw yesterday. His comments following that decision by the Bank of England, but Bailey adding that it's too soon to declare victory just yet against inflation. Pressures are still there. As for the ECB, it explicitly signalled at least one hike of the same size at its next meeting in March. This is the quote. The Governing Council, the ECB, intends to raise interest rates by another 50 basis points at its next monetary policy meeting in March, and it will then evaluate the subsequent path of its monetary policy. Christine Lagarde insisted in the press conference, we know that we have ground to cover. We know that we are not yet done. I won't show you the euro-dollar chart just yet because I want to show you that in the context of data out later on today. But what I do want to do is to show you what's going on with the dollar basket. Because yesterday we saw the dollar rise against a whole basket of other currencies. In the last couple of days, we've seen it disappear below this line of support at 101.10, which I've been looking for as a price target. And that then that lower close there led me then to believe that we were then on our way down to this next line of support down here at 97.68. I still think that's the case, but at the moment at least, had you taken what we were talking about yesterday as a trade idea here, with that close down on Wednesday below that, I was then going to go short on this down to 97.68 with my stop neatly packed in just above this line of then resistance. But of course, then came this rise. We were stopped out, and so we've stopped that trade. But I still think if you look at the direction of travel that we've seen from the highs that we had back on the 28th of September, this is a trend in place. You're going to get these little bubbles where we see a rise on the session. I don't see anything that indicates to me that we've got anything where we're going to see strength of the US dollar in the next several months or so, especially if the ECB continues to raise interest rates and the Bank of England ditto. And I think that 97.68 is potentially the next line to watch out for. And that would be a price target if you are short on this. If you're short and you want to keep in the game, your stop would go above this little inverted hammer here. So you'll stop at around about the 102.50 level. If you're short on this, 101.50. And as I say, the price target down here at 97.68. Now, that's a long-term play for the dollar basket. Yet, the dollar could well continue. Well, we've seen it fall for the week for sure at the moment. But it does rest on this non-farm payroll data. But what this move in the dollar has done in the last 24 hours has skewed trade in gold. We were talking yesterday about this bull market in gold for the rise from the 28th of September all the way up to the highs that we saw intraday yesterday, taking us up 21.35%. And then look what happened. Yesterday was the biggest single day of declines for gold that we've seen since July last year. And at the moment, we're building on that. Now, the big question is for me is why is the dollar rising when you've got US 10-year yields falling? We've got risk assets in play. Why is the dollar rising? There's another part of this puzzle, I think, that's playing out with some people, and maybe they don't believe that perhaps maybe that the Fed is done on interest rates. Well, one of the big bit of data points to watch out for today is going to be non-farm payrolls, and that's going to give a little bit more of a picture to the way in which we're seeing this US market and the economy develop. I can't help but think that the Federal Reserve voting members hadn't seen this data when they made that decision on Wednesday. We're looking at the moment, according to economists' reports, of something like around about 185,000 job creations in the month of January, 223 in December. Now, that was an upside surprise. Do we get another upside surprise? This figure out at 1:30 p.m. today. Unemployment rate's expected to rise to 3.6% from 3.5% in December. Don't forget the unemployment rate data is taken at a different point in the month, and it doesn't always represent job creations. Average hourly earnings 4.3%, still below the inflation rate. So earnings are not keeping up with the increase in prices. I will be with Josh today at 1:25 p.m. Today with Josh for non-farm payrolls. Do join us on the IG platform for that at 1:25 today. Also in the US, we get ISM Services PMI data for the month of January. Economists expecting it to rise to 50.4 after 49.6 in the month of December. So all this contributing to potential trade around the euro dollar. Let's take a look at this trade and work out where it goes. It is the inverse of the dollar basket. So to some degree, if you are trading the dollar basket, you'd be doing this in the opposite direction. If you want to stay in the game, but you want to take part in this trend, your stop goes down underneath here. There'd be a long trade. Your stop goes down here at around about the 107.50 level. We're currently trading at 108.94. Your price target is the high we had here back on the 30th of March at 111.80. Direction of travel up. We're bound to get these pullbacks, and I think if you want to stay in the game, you want to put your stop down, as I say, below this low point we had back on the 31st of January. So that is, to me, the direction of travel. Like all these things, they are not trade recommendations. It's just my positioning in the market and how I feel about the way that the markets are beginning to develop in this upward trend that we've had. You can see these rising lines of support, the breaking of these rising lines of resistance, and this continues to be a trend that I'm sort of locked into as things stand there at the moment. So if you're long on this at 108.94, stock goes down here at 107.50 with a view to taking it up to this line of resistance at 111.80 as a price target. A big event on Thursday evening, late in the markets for tech earnings. I want to take a quick trip round some of the numbers that we saw. I want to begin first of all with Apple. Paired gains last night after the company's fiscal first quarter earnings came out. The group posted earnings of $1.88 per share, a 10.9% drop compared to the same quarter last year. Analysts expected $1.94. Revenue falling by 5.5% to $117.15 billion. The first year-over-year sales decline at Apple since 2019, 121.88 billion was expected. Let's take a look at what's happened in the share price chart. And you can see, if you look at what's been going on here for the point at which we closed out the session last night, these are 30-minute candles. The point at which we closed out the session last night to the point of where we saw all sessions close, we were down 3.48% for Apple shares. It all comes as iPhone and iMac revenue came in short of estimates. Apple chief executive Tim Cook said three factors impacted the results: a strong dollar, production issues in China affecting the iPhone 14 Pro and iPhone 14 Pro Max, and the overall macroeconomic environment. It wasn't just Apple, it was also Amazon. Shares were quite jittery in the extended trade last night. The internet giant missing earnings estimates, posting EPS of 3 cents compared to 17 cents forecast by analysts as we saw them prepare for the release of that data out last night. Revenue better than expected at 149.2 billion. Investors were taken aback by the group's guidance. Amazon said its operating profit could fall to zero in the current quarter, as savings from layoffs do not make up for the financial impact of consumers and cloud customers clamping down on spending. Look at what happened on shares last night. Again, 30-minute candles, you can see that we were down 5.07% from the point we were at when we saw the initial release of the numbers, which saw stocks in Amazon rise initially, but then there was a drop of 5% as at the close last night in extended trade. The company believes sales growth in its long, lucrative cloud business will slow for the next few quarters. In Q4, Amazon Web Services sales reached 21.3 billion against 21.76 billion expected. It didn't stop there either. Alphabet, another one, missing on both top and bottom lines for its Q4. Google's parent company posting earnings of $1.05 a share on revenues of 76.05 billion, both short of forecasts. Alphabet suffering from a pullback in advertising revenue. Advertisers have cut their budgets as rising inflation and interest rates fueled concerns over consumer spending. Again, looking at what happened on the 30-minute trade for Google stock or Alphabet stock late in the session yesterday, we saw a pullback of a margin of almost 5%. So you can see all these companies contributing to that pull away from the bull market that we've seen in both the S&P 500 and the NASDAQ. For Alphabet's point of view, the company said it would take a charge of between $1.9 billion and $2.3 billion, mostly in the first quarter of 2023, related to the layoffs of 12,000 employees it announced back in January. So, tech's front and center. Outside of that came Ford earnings, which one might have thought perhaps maybe might have been a little bit of a light relief from some of the negativity we've seen in some of these tech stocks, but none of it. Earnings per share, 51 cents. Estimates have been for 62 cents a share. Revenue coming in broadly in line with expectations of 41.8 billion. Ford predicted a difficult year ahead, blaming chip shortages and other supply chain issues, production instabilities that raising costs, along with lower than expected volumes. In 2022, the company recorded an adjusted profit of $10.4 billion, short of Ford's own forecast of $11.5 billion. Ford expects 2023 adjusted pre-tax earnings of $9 to $11 billion. And as a result of that, we saw shares fall in extended trade. These are daily candles, and you can quite clearly see the subsequent drop that we saw in the trading day yesterday, resting at the 200-day moving average, down 4.22% when all was said and done in Ford stock. Now, let's shift into other areas of the market and just quickly remind ourselves of what happened last week with the Baker Hughes rig count. We got that out again at 6 o'clock this evening. Total rig count remaining flat last week at 771. The number of oil rigs in operation fell by 4 to 609. Now, this would normally see oil up. But in fact, what happened overall in the week, and if you look at the chart, you can see since the release of that data last week, it's been a disastrous week for traders, unless, of course, you're short on this market. If you continue to be short, your price target is down here at 72.65. You've got the Baker Hughes rig count out this evening. The only thing I would say is if you look at the move that we've seen on this market, I just want to draw a Fibonacci to give us a working out where this line of support is. You can see that we are in amongst the thick of this support line here between 61.8 and 76.4% retracement. If you do see a dip below the 75.24 level, which is the 76.4, you're then on this price target down here, a total retracement at 72.88. But at the moment, at least, it's been held up on that fib retracement. A good area of perhaps possibly maybe an opportunity to take it up again. If you do go long on this at these levels, your stop goes underneath the low point of the candle that we saw back on the, what was that, the 5th of January, down here at 72.63. So you'll stop at about 72.50 if you go long on this at these levels. But I'd want to see evidence that this line at 75.04 is holding on US crude. Baker Hughes rig count out this evening. Let's just update you on a couple of other areas of the market. I want to show you what's been happening with Bitcoin. Yesterday, we saw the highest print on Bitcoin since the 17th of August last year. Now, it's quite difficult to trade cryptocurrencies on any market because of FCA regulations. So one of the ways in which many do this is by proxies. And one of the proxies is Coinbase. And Coinbase has been making up some of the lost ground as well recently. Yesterday, we closed off the highs. Trading at one point yesterday at levels not seen since the 18th of August last year, and Coinbase closed out all sessions last night at 77.75. Now, it's the first time we've been above the 200-day moving average since we started this trade. It's only been in the market since the 15th of April 2021, and you can see the red line here, the 200-day moving average kicked in after 200 days of trade on the back end of January last year. So it's the first real time we've had a test of this line on the 200-day moving average. This red dotted line, for those of you that are not familiar with Coinbase, is the IPO placing that we had back in April 2021. So we're well away from that 225 level at 77.75. But I think if Bitcoin and other cryptocurrencies do continue to gain some level of steam, then I think this is an opportunity here to trade this up on a long trade. In amongst some of the other moves in the markets that we've seen record highs for New York orange juice. It's broken historical resistance and continues to move up in what is a market where we've seen recent higher highs, and it has been an amazing push up. This line at 227.82 was the previous record high that we've seen. I'll show you that in just a moment. You can see a very, very strong candle yesterday. It's all down to Florida production, where the harvest is forecast to be the lowest in 90 years, so supply very much constricted. Florida production is hit by a combination of extreme weather and a disease impacting citrus fruit. Last month, Hurricane Ian destroyed up to 80% of the orange juice crop in some parts of Florida. The Agricultural Department in the States announcing last week that Florida's production is expected to be more than halved compared to 2022. Prices that will benefit the Brazilian harvest, the world's largest producer. But look at this in the context of where we've been before. You can see twice in the last couple of decades we've hit and stopped at this 227.82 level. That first one was back in the 23rd of January 2012. This second one here was October 2016. But this move past that is obviously going to raise prices in shops, adding to this level of inflation. That's it. We're back at 10:30 with Charting the Markets. Hope you can join us there for that. There's not much in terms of individual stock stories to watch at the start of today's trade in the European markets, but I would urge you to look at your IG platform at 9 o'clock this morning to see how we see some of these all sessions stocks open that did so badly late last night. Apple, Amazon and Alphabet all open at 9 o'clock. All sessions on the IG platform. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.